If you're in the market to buy a new home or simply thinking about refinancing the one you have, mortgage rates make all the difference. Yes, the rates are higher, but did you know that 25 years ago, rates were triple what they are today? Here's some perspective. Any recent home buyer can tell you mortgage rates have been on the rise recently, albeit from the rock bottom levels of the past few years. 30-year mortgages hit a low of about 5% in June 2003 and have been inching up ever since. These days, they now stand at about 6.25%. The projection for the rest of the year, more of the same.
It's been a fairly flat rate environment for 2004 and 2005. Most of us are expecting modest increases in 2006, ending the year at around 6.5 to 6.75%.
Mortgage rates have been pushed up by rising interest rates, not just in the United States, but in Europe and Japan as well. And analysts don't project mortgage rates easing anytime soon, not with the Federal Reserve likely to raise U.S. short-term rates again soon. Business Week chief economist Michael Mandel says rising interest rates mean that consumers should steer clear of adjustable rate mortgages and put their money squarely in the fixed-rate 30-year market.
These are still low rates in historical terms, so that when the mortgage brokers or the real estate brokers say, these are still good rates, they're right.
In fact, mortgages haven't been this low since the 1960s. To put it into perspective, mortgage rates are currently 1/3 of the early 1980s, when inflation drove rates up to 18%. The big danger these days, according to analysts, is not that mortgage rates will shoot to the moon, but that they will rise enough to make refinancing or even home buying a less attractive option and weigh on the broader housing market. With rates climbing, how do you decide which mortgage is right for you? Here to talk about that is Bob Moulton, president of Americana Mortgage. Bob, good to see you.
Good to see you too, Jerry.
I think the problem that consumers have right now, if they're in the market, on the one hand, rates are rising, but prices haven't declined yet, so they're in the worst of both worlds. What do you tell them?
Well, each time we make a consultation with a prospective homeowner, we take a look at what their financial situation is. And when we look at mortgage rates today, mortgage rates are about 1% higher than where they were 4 years ago.
Right.
So 4 years ago we were at 5.25%. Right now we're about 6.25%. But there are some attractive alternatives today, such as adjustable rate mortgages, a 5-year adjustable, an interest-only mortgage, and a 40-year mortgage. So those are great alternatives to prospective home buyers.
We just heard an expert say, though, that now is not the time for those fancy-smancy products, that you don't want to be in an adjustable right now because those rates are going to go even higher for you. Should you lock into a 30-year fix knowing that, at least you're going to be well below long-term averages?
The homeowner really has to take a hard look in terms of how long they're going to stay in the house. If they're first-time home buyers, maybe a dual income with no children, and they go into a 2-bedroom house and plan on staying there 3 years, the 5-year adjustable may work for them, and it'll save them about 8% on their monthly payment.
It's hard to know exactly how long you're going to stay in a house, but if you do have a clear view, you can match your mortgage to how long you're going to be in the house. But what about that 40-year? Instead of paying for your house over 30 years, you're recommending paying it over 40 years. That means a lot more in interest costs. That sounds like just a bad deal.
It's begrudging to think about having a mortgage for 40 years, but the average homeowner only holds their house for 7 years. And when you look at prospective homeowners' payment, it's all based on cash flow. So they're looking at how much money they take home and how much they can put into a monthly mortgage payment. When you put it into that perspective, the 40-year mortgage could be very attractive for the right homeowner.
Of course, you don't have any equity at the end of the day. If you're paying over 40 years, you're paying even more in interest costs. That might make it unattractive. I think people out there might think that one solution to the problem is that you just buy a cheaper house at the end of the day. Maybe you scale back your expectations.
Well, there is some talk about the inventory that's out there. And there are so many houses out there for sale today than there were a year ago. And with the old supply and demand equation, hopefully the sales price will come down a little bit and maybe these homeowners can step up a little.
I know a lot of people are really hoping for that. What's your outlook, though, for the balance of the year for mortgage rates? Are we going to get more of this, more rising rates? Which would mean maybe you should do it now instead of waiting. I know a lot of people are weighing that option as well.
People always try to time the market. They try to time the market in terms of interest rates. They try to time the market in terms of house prices. If you like the house and it's a quality of life situation, buy the house now. You can't not necessarily time the market. So in terms of the end of the year, I think rates will be higher, probably close to 6.95%. I think housing sales will be down about 6%. And I think the prices might soften up a little bit, but when the prices soften up and the rates are higher, you're probably going to be in the same place at the end of the day.
So some opportunity for some people. Bob.